name's Rowan Pence, Executive Director at the Australian Chamber of Commerce in South Korea. It is my absolute pleasure to welcome you to today's special webinar with our gold sponsor, ANZ. Just when the world was seeing the light at the end of the COVID-19 tunnel, Russia triggered a major geopolitical shock when they invaded Ukraine. The impact of surging commodity prices, the supply chain disruptions are all clouding South Korea's economic outlook. This brings us to today's webinar topic, Korea Economic Outlook, going from pandemic shock to geopolitical shock with our guest speakers, ANZ's Head of Research, Khoon Goh, and ANZ economist, Krystal Tan. They'll be on hand to discuss the implications of South Korea's economic outlook and what it means for the external position, monetary policy, and the Korean won. Now, without further ado, I'd like to pass on to Khoon, who's our very first presenter. Welcome and thank you.
Thank you very much, Rowan. Doboseo, everybody. Thank you for joining us on this webinar today. So there'll be two parts to our presentation. I will start off with looking at an overall view on the global and regional economies of the conflict in Ukraine, and then Krystal will dive slightly deeper into the implications for the Korean economy. Now, as Rowan said, it's actually rather unfortunate with what's happening in Ukraine. It's a very tragic humanitarian crisis that has emerged. And in a sense, it was a shame because the global economy, and particularly for the Asian region, was actually starting to look pretty good at the start of this year. And I was getting quite optimistic about the outlook for the global economy and for the Asian region in particular. There were very clear evidence that the Asian economy was starting to pick up a lot of growth momentum towards the end of last year and in the early start of this year. And if you look at some of the high frequency indicators that we tracked, for example, we note that there's been a very solid bounce in the PMI since the end of last year as economies around ASEAN in particular started to open up as the worst of the pandemic wave was behind us. And things were starting to look up at the early stage of this year. If you look at the various mobility indicators as well, they are showing that there's been a lot more activity going on. Movements in some places were back to pre-pandemic levels, a clear sign that easing restrictions is starting to see people starting to normalize their activity. Now, unfortunately, the outlook now has been clouded by the Russia invasion of Ukraine. So how do we assess the implications of this? As I mentioned earlier, it is a great tragedy in terms of what's happening, but as a heartless economist, I need to assess what that means in terms of the economic implications. Now, there are a few channels that the conflict will have an impact on the region and ultimately on Korea. The first and most obvious one is the impact through soaring commodity prices. And I'm sure every time you now fill up your car with petrol, you are basically paying the price of what's happening. So all prices have surged, and it's not just all prices this time, but also broader commodity prices, in particular for wheat, and the spillover into other agricultural products have also risen very, very strongly. So this time around, the commodity price shock is a lot broader than just energy. And it's going to be filtering through into the daily essentials, in particular food as well. Now, the impact on energy-related prices is a lot more immediate. The flow through into food prices is yet to be felt, but I'm sure that will become increasingly more apparent as the year progresses. And what does it mean for inflation? Quite simply, it just means that inflation is set to rise as the year progresses, and probably to levels that for many countries we haven't seen for probably a good part of a decade. Now, the impact on high commodity prices will be felt differently depending on which country you're in, and the composition of your export, and whether or not you're a major exporter or importer of energy. If you take inflation for a start, as I mentioned earlier, it's not just oil and energy prices that have shot up, but the broader commodities, particularly for agricultural products, have increased as well. So therefore, that means that for those economies that have a much higher weighting of energy-related items or food in their inflation baskets, they will feel the inflationary impact a lot more acutely compared to other countries. So this chart here on the left shows the level of importance of transport, which is very heavily influenced by oil prices, and food in the various CPI baskets. And right at the top, you can see Thailand and India have very, very high weightings of transport and food. Over 60% of the CPI basket is heavily influenced by those. And at the other end of the spectrum, we have China and Korea, which has a much lower level of importance of energy and food in their CPI baskets. So what that means is that the inflationary impact will be felt more potentially in Thailand and India compared to Korea and China. Now, this doesn't take into account things like subsidies, for example. Some countries do provide fuel subsidies or cooking oil subsidies. So that will help to mute the impact of high prices towards consumers. But of course, such subsidies cannot be sustained for too long, and eventually some of that price pass-through can be expected. So that's the one immediate implication. And secondly, in terms of the country's export and import composition, we're going to see quite large effects of that as well. Now, in this part of the region, there are only two countries that are net energy and commodity exporters, which is Malaysia and Indonesia. So those two stand to actually benefit from the current high oil and gas prices. And because Indonesia and Malaysia are also major exporters of palm oil, and palm oil prices have increased, Indonesia is a major exporter of coal as well. So if you take the broader commodity basket, it's quite a decent share of the overall trade, and therefore they stand to benefit from the high prices. For the rest of the economies in this region, everyone else is pretty much a net importer to varying degrees. Korea, for example, overall imports of the broad commodity basket is getting close to about 6% of GDP. So the high prices immediately translates into the need to spend more on imports, and that will obviously narrow the current account surplus, which Krystal will talk to in more detail. So those are the immediate impacts that we can expect from the commodity price effect. If you look at the next channel, which is through trade, and I think this channel is probably a little less severe in the initial reading. Asia doesn't actually conduct a lot of direct trade with Russia. So with all the sanctions being imposed and the Russian economy effectively now going into a very, very sharp contraction, that obviously will have implications for trade. But thankfully for most of Asia, direct trade with Russia accounts for less than 1% of their overall trade relationship, which is about here. Now, China has the highest trading relationship with Russia, but even then, trade between Russia and China accounts for only about just over 2% of overall trade with China. So its overall importance is not that great. So while there will be some impact from reduced trade with Russia, it is not material enough to really significantly slow things down. But where the trade impact will be greater is indirectly through a slowdown in European growth. Now, Europe is going to be more directly impacted by the Ukraine conflict and the sanctions against Russia. And that's because Europe is very reliant on Russian oil and gas. And we've seen the implications of that right now, where Europe was not able to completely stop buying gas from Russia, or else they'll freeze to death, or they'll have massive implications for their economies. It's going to take time for them to source alternative energy from other countries, so they can't completely wean themselves off from Russia. Although they're taking steps now to do that over the course of the next few years, but for the time being, they're having to pay a very heavy price in terms of a huge increase in how much they have to pay for gas and oil and these other products. So that will act to slow down European growth. And that's where most of the impact on Asia will be felt, through a reduction in economic activity in Europe, and therefore through trade with Europe. So for Asia, trade with Europe is actually quite important. The EU accounts for almost 10% of overall trade with Asia. So this impact will be more apparent and is of greater risk to Asia's overall export performance and overall growth. Now, this is not going to be felt immediately, unlike the impact of commodity prices on inflation. This will, I think, become more evident as we enter the second quarter of this year, and definitely in the second half of this year, as the effects of a slowdown in Europe usually take time to trickle through into slowing activity. And this is, sort of one of the major channels that we expect to drag on growth. There's also another channel, which is actually through financial markets. Now, we've seen a lot of volatility in markets, and all these serve to tighten financial conditions. And if you look at what the market is telling us, there has actually been a tightening in financial conditions in recent months. And this tightening in financial conditions historically has acted to slow growth down. So this chart here on the left is our own proprietary financial conditions index. You can see historically it's actually had quite a decent lead property over growth in the region. So every time there's a massive tightening in financial conditions, you do see a sharp slowdown in growth. And this time around, financial conditions have tightened, but thankfully it's not tightened to a level that is warning of a much deeper slowdown in growth, like what we saw during the global financial crisis, for example, or during previous periods of tightening. But this is definitely something I'm watching very closely, because if we see a further tightening in financial conditions, then that's going to signal or forewarn of potentially a deeper slowdown coming. Now, another factor that can also tighten financial conditions is what central banks do in this region. We've already seen the Bank of Korea start to tighten rates from last year, and they continue to do so. They've been joined by the Singapore Monetary Authority, which also started to normalize policy, and the Taiwan Central Bank was the latest central bank in this region to begin tightening policy as well. And we anticipate other central banks in this region to also start to normalize policy in response to high inflation, but also a recovery in their economies. And as a result, central bank tightening do serve to tighten financial conditions, which again will lead to slower growth. Again, if you look at our central bank policy diffusion index, for example, when we have enough central banks tightening in the same direction in a synchronized fashion, there is a risk you're going to get a slowdown like what we saw during earlier periods of tightening. So again, this is another factor that I'm watching quite closely. If we do see the inflationary impacts start to force central banks to bring forward their tightening, then that could signal a risk of a sharper slowdown in growth in the region. And of course, The most important central bank of all is the US Federal Reserve, where the Fed has turned extremely hawkish, and they've started to hike rates in earlier this month, and signaling that they're prepared to hike even more aggressively in order to tame inflation. The US Central Bank is very, very important in terms of the policy setting, because that does have tremendous influence on the US interest rates, but that also filters through into interest rates globally as well. And we've already seen sharp moves in US 10-year yields, for example, and that's reverberated through other fixed income markets globally. Now, we think for the US economy, inflation is the bigger concern. And whilst the uncertainty caused by Ukraine does cloud the US economic outlook as well, the US is quite simply less exposed to what's happening with Russia compared to Europe. So while there's no doubt there will be some impact, overall it looks like the impact on the US economy will be quite small or quite manageable. After all, the US is now a net energy exporter thanks to the shale oil revolution. So high oil prices doesn't have the same negative impact on the US economy like it did 10 or 15 years ago. In fact, high oil prices could actually serve to benefit the energy sector in the US. On top of that, the US is also a major producer and exporter of agricultural products. Let's not forget, during the US-China trade war when Trump was president, Trump was trying to force China to buy more of America's agricultural products. So with soaring wheat prices and other commodities, I'm sure there are a lot of happy farmers in the Midwest. So the point is that while US consumers will complain every time they fill up their cars with petrol, but it's not all bad. There are some segments of the US economy that will benefit. So that's why for the Fed, inflation is the bigger worry, which is why they are preparing to hike more aggressively, because they are not as concerned about the negative impact on growth. So that means the Fed, despite the geopolitical uncertainty, will look to take interest rates towards neutral levels as quickly as possible. So we are forecasting the Fed funds rate to increase to 2.25% by the end of this year, and increasing further to 3.25% by the middle of next year. So you can see from our forecast, this is a very, very aggressive Fed tightening cycle. Something that we haven't seen for quite some time. And this will have important flow-on implications for Asian central banks as well. As I said, I think the risk is we might see them being forced to tighten earlier as well in response. Now, the big question at the moment is, given the geopolitical uncertainty with the Ukraine conflict, given high inflation, high oil prices, and now the Fed embarking on an aggressive tightening cycle, is there a risk that what the Fed is doing could tip the US economy into recession? And if that happens, then obviously that's going to have huge implications for the global economy. So there's a lot of focus in markets on the shape of the yield curve. There's a question about whether if the yield curve starts to invert, does that signal a high chance that the US might go into recession? Now, at this point in time, the indicators do not point to a high likelihood of a US recession. So the best yield curve indicator historically is the spread between the 3-month and 10-year US interest rates. And building a probability model of recession based on that, at the moment is telling us the probability of a recession in the US 12 months from here is very, very low, at less than 10%. So it's not flashing any warning signs. Yes, obviously, markets are attuned to the possibility of that, but the US labor market is still extremely strong. Generally, if you look at the latest corporate earnings announcements, still growing revenue, still pretty solid. So there are no indications of any obvious signs of stress in the US economy, and Fed hiking rates aggressively at this stage doesn't look like it's going to threaten the US economy. If the yield curve starts to flatten further, and this probability starts to increase. And the critical threshold is really this dotted line here, 30%. Historically, once this probability model starts to get towards there, then we should all start to worry, because historically that has given a very, very strong hint that the likelihood of a recession in the US 12 months out is extremely high. But we are not there yet. I think that's the important message for the time being. And finally, let me just conclude with this thought, in that at this point in time, it's extremely easy to be very negative, very bearish. After all, you look at high oil prices, geopolitical uncertainty, Fed tightening. It's very, very easy to get very negative about the outlook. But let me just remind you all that, especially in this part of the world, there are actually some tailwinds that are emerging that can help to offset a lot of these headwinds. Firstly, the pandemic situation is starting to get under much better control, with the exception of China probably, but for the rest of Asia, it's generally moving in the right trajectory. Therefore, we are seeing ongoing plans to reopen economies and, more importantly, open up borders. Last week was a very significant announcement coming up from Singapore, where I'm based, where the government has now been confident enough to fully welcome visitors into Singapore quarantine-free. They've established a resumption of land border travel with Malaysia without the need for testing both directions. So a very clear signal that we're moving into normality. And I think we're going to see more and more ASEAN countries start to follow suit. So that's going to be a huge boost to domestic demand, independent of what's happening to Ukraine, independent of what's happening to the US Fed. That is going to see pent-up demand being unleashed. And with the opening of borders, we're going to see a pickup in international travel. Again, I'm pretty sure there's a lot of pent-up demand there. And I think a lot of people can't wait to start to travel again, either for business or for leisure. So this is, I think, going to be quite a powerful force that will be unleashed this year that will help to offset some of these negativities that are coming, which is why I'm still broadly optimistic about the growth outlook for Asia. Probably the rebound will not be as strong as what I was anticipating at the start of this year, because the Ukraine conflict does introduce some downsides, but let's not lose sight of some of these tailwinds as well, which will still be responsible for driving the growth recovery for this year. So that's it in terms of my section. I will now hand over to Krystal for her to cover the Korean economy in more detail.
Hi all. Thanks, Khoon, for the introduction, and thanks everyone once again for joining us today. So for my section, I'll be focusing more on the outlook for South Korea. And as Khoon has shared, right, there's certainly a number of global headwinds brewing. And given how trade-oriented South Korea's economy is, naturally these global factors will have a very significant influence on South Korea's economic outlook. But before I go into the implications of these developments for Korea, I'd like to start by first taking stock of where South Korea's economy is currently at. Next slide, please. So Korea entered 2022 on a pretty solid footing. From a regional context, Korea's economy has weathered the pandemic pretty well over the past 2 years. By early 2021, Korea's GDP was already back to its pre-pandemic size, and the economy has continued to grow since. Whereas if we look at some of the less developed economies in the region, some have yet to recoup all the losses caused by the pandemic. So essentially, South Korea has entered the year in a pretty robust position. Of course, Korea has had to contend with a couple of virus waves in recent months that probably sapped a bit of the wind out of the sails. First, there was the Delta wave around the turn of the year. And then shortly after, Omicron hit, and that wave dwarfed all the previous ones Korea had seen in terms of the number of cases. But the economic impact has been milder with each wave. Disruptions were fairly minimal. Next slide, please. If we look at sentiment indicators, the pullback has been fairly mild. So the chart on the left shows consumer sentiment. Both the overall index and the sub-index on household income expectations are still above pre-pandemic levels. And in fact, we got another data point this morning and it showed an improvement. The chart on the right shows business expectations. Yes, confidence has softened a little bit, but firms on the whole are still more optimistic now than they were pre-pandemic. And this applies to both export-oriented and domestic-oriented groups. Next slide, please. And things on the virus front are actually moving in the right direction now. The latest case numbers suggest the wave may have peaked. And with the majority of the population having received the booster shot and also the fatality rate lower than earlier waves, now South Korea is gradually shifting towards endemic living. So the light blue line on the chart shows Korea's stringency index. So a lower number signals less restrictions, and a further decline looks to be on the cards. And as this reopening gains traction, this is going to be good news, especially for the contact-intensive services sector. Next slide, please. I think it's quite encouraging that the labor market has continued to strengthen in recent months, despite the virus resurgence. If we look at the unemployment rate, that came in at just 2.7% in February, and that's despite a higher participation rate, meaning more people were actually looking for jobs and are able to find jobs. The economy actually added 1 million jobs from a year earlier. Now, there was a temporary expansion in the medical workforce and government job support programs that have helped boost the headline employment numbers. But there are also signs that the contact-intensive sectors that were hit hardest during the pandemic are now starting to ramp up their hiring in anticipation of improving demand and loosening restrictions. So if you look at employment in sectors like accommodation and food services, wholesale and retail trade, they are still some way below their pre-pandemic levels. So the recovery has further to go and will receive another lift as restrictions are eased further. And more broadly, as this transition towards living with COVID-19 accelerates, this would pave the way for a more balanced recovery in South Korea. Next slide, please. Okay, so this chart shows the pattern of economic recovery we've seen in Korea so far. I mean, over the past years, the recovery has really been led by strong goods exports and also fiscal support. But this post-pandemic era should provide some tailwinds for private domestic demand to do some catching up. So things are looking up in terms of Korea's pandemic recovery, but unfortunately, the conflict between Russia and Ukraine has happened. It is, of course, first and foremost a humanitarian crisis, but from an economic point of view, it has also introduced shockwaves to the broader economic outlook. So to assess how this conflict affects Korea from an economic angle, there are three main channels that we look at. Next slide, please. So in terms of trade exposure, direct exports to Russia and Ukraine actually very low in South Korea. Exports to Ukraine are minimal, whereas Russia accounts for about 1.4% of Korea's exports, and autos are the top product that Korea sends to Russia. But of course, we have to consider the second round effects as well. The EU, it's a much more significant export market for Korea, about 10% of exports. And given how the close trade links between EU and Russia and Ukraine, so the bloc will be susceptible to a more material growth slowdown. So that will have some spillover effects on its demand for Korean goods. We also have to consider the potential disruption through the import channel, right? Because the conflict could trigger supply bottlenecks and also production shortfalls. The key challenge is that Ukraine and Russia are dominant producers of some key raw materials that including inputs for semiconductors and autos, both of which are very important sectors to Korea's economy. Next slide, please. Yes, so as we can see in the slide before this. Yeah, as we can see in this chart, semiconductors account for 20% of Korea's exports, while autos accounted for about 7%. Of course, semiconductors are also key inputs for many other sectors, including electronics. And we've seen how disruptive global chip shortages can be over the past year or so. So the thing is, Ukraine is a key producer of noble rare gases like neon and krypton, which are key raw materials in the chip production process. So as an example, Ukraine is estimated to account for about 70% of the global production of neon. And economic activity in Ukraine has been significantly disrupted by all the military action. So for now, chip makers have put down concerns thanks to preemptive inventory stocking. And in fact, trade data for the first 20 days of March do show that Korea's chip exports are still very strong. So the short-term impact has been minimal. But the risk is if the conflict is prolonged and inventories are drawn down, it would be quite challenging to find sufficient alternative producers given how dominant a market position Ukraine has had. Similarly, Russia is a key producer of palladium. That is a key input for both the chip and auto sectors. Russia's share of global production there is about 40%. So the risk is if Russia opts to restrict its exports. For now, palladium isn't in Russia's counter-sanctions list, and restricting palladium exports wouldn't be in Russia's favor, given that it's a source of foreign earnings. But it's still a watch point because if they choose to go down that route, it's going to be difficult for the rest of the world to fill the shortfall in a short span of time. So for now, Korea's production hasn't been impacted, but this sort of potential supply chain disruptions are big potential risks that they're watching because if materialized, they will impart a significant hit to economic growth. Now, where we are seeing a more immediate impact from the conflict is through the surge in commodity prices and the pressure that is exerting on Korea's trade balance and also inflation. Next slide, please. So, as we know, Russia is a major energy exporter. In contrast, South Korea, like many other Asian economies, is a major importer of energy. Korea's mineral fuels deficit is in excess of 5% of GDP. But Russia is also a significant producer of metals and agricultural products. Ukraine, also a major global supplier of agricultural products. So once we consider these other commodities as well, South Korea's broader commodity deficit is closer to 6% of GDP. Next slide, please. So the sharp surge in commodity prices has effectively delivered a tons of trade shock to South Korea. Basically, its import prices are rising much faster than its export prices. This deterioration is reflected in the chart on the left. The dotted line shows the average move in March, month to date. This is pretty sharp move there. And so what this means is that Korea's trade balance is going to come under more pressure. The chart on the right shows Korea's mineral fuels deficit versus Brent oil prices. The dotted line represents ANZ's oil forecast. So we expect oil prices to average above $100 per barrel this year. So that implies that the mineral fuels deficit is going to be significantly larger than the 5% of GDP number that we saw last year. The next slide, please. And this deterioration in the trade balance will have negative implications for the current account. And there are now growing concerns that South Korea's current account surplus may even slip into a deficit. But I think one silver lining is the shipbuilding sector. They saw strong orders in 2021 and 2022 year to date. So ship orders usually take a couple of years to deliver, and exports only show up in the customs trade data when the ship is delivered, but payments for ship exports tend to be made in stages. So this will show up in the goods balance. And the other factor that will offer a bit of buffer is elevated freight costs, because Korea is a net transport services exporter. So the services account will show an improvement whenever freight costs are very high. So overall, we do think that the current account would still be able to record a surplus, but it will still be much smaller than before. So we are forecasting a 2% of GDP current account this year. That's versus almost a 5% last year. Now, the other channel through which the Ukraine-Russia conflict will have a clear impact on Korea is inflation. Next slide, please. To be clear, Korea was already facing significant upward inflation pressure even before the conflict. The chart on the left shows the drivers of Korea's inflation. Korea's inflation has averaged above 3.5% in the first 2 months of 2022. For context, the average over the past decade was just 1.3%, and the central bank's target is 2%. So food and transport have been key contributors to overall inflation, but it's also worth noting that price pressures in the other components have also been steadily building over the past year amid the ongoing recovery. So we take housing rents and restaurant prices, for example. Both have also been rising, and they are indicative of rising demand-side price pressures. The chart on the right shows the gap between Korea's producer price inflation and consumer price inflation. So this gives us a sense of the extent through which producers are passing through higher costs. So in the initial stages of the recovery, producers bore most of the increase in raw material prices. But as the recovery gained traction, pricing power returned, producers have started to pass through the increasing costs. And given how elevated the PPI-CPI gap still is, this suggests there is quite a bit more inflationary pressures in the pipeline. So basically more upward pressure on inflation in the coming months. And these data only extend through to February. They do not reflect the impact of the Russia-Ukraine conflict yet. That will only be clearer in the March data that's due next month. Next slide, please. But when you look at higher frequency data, such as retail fuel prices at Korean gas stations, which is shown in the chart on the left, there has been a clear surge in March. So we can expect inflation to stay close to 4% in the coming months. And inflation expectations, which were already elevated prior to the conflict and some way above the BOK's 2% target, set for another leg up. In fact, we just had data this morning as well. It showed inflation expectations moving up by another 0.2 percentage point to hit an 8-year high. So as a guide, every $10 per barrel rise in energy prices relative to 2021 levels would raise inflation in Korea by about 0.5 percentage points if it's fully passed through. In practice, the pass-through can be muted by policy measures, including adjustments to the fuel tax structure, as we have seen in Korea. So what does all this mean for the Bank of Korea and its interest rate policy? Next slide, please. So the BOK was among the first to embark on a rate hiking cycle. It started as early as last August, and it has done a total of 3 hikes worth 75 basis points altogether so far. So that has brought the policy rate back to its pre-pandemic level already at 1.25%. But now that we have inflation holding above the 2% target for almost a year, exceeding the 3% mark for several months, and now set to remain elevated for longer, that policymakers are under pressure to anchor rising inflation expectations. So we do expect to see another 3 hikes this year, 1 per quarter, with the next probably materializing as soon as next month. So this will bring the policy rate to 2% by year end. But at the same time, I think there are several reasons why the Bank of Korea will not be as aggressive as the US Fed. First, of course, the BOK has moved earlier, so that should help slow the build-up in imbalances. Next, unlike US consumers who have deleveraged over the past decade and therefore are in a much stronger position, Korean households have done the opposite. So the chart on the right shows household debt servicing burdens in the US and in South Korea. So Korea's numbers are reflected in the dark blue line. It's debt servicing burdens for households. So basically the amount of income that is spent on servicing debt is high by historical and global standards. So what this means is that the Korean economy has less capacity to absorb aggressive rate hikes. Finally, our outlook for the Korean won. Next slide, please. The Korean won is among the worst performing Asian currency year to date, and that is despite the strong export performance and despite the BOK being one of the first movers in terms of normalizing its policy. So there were a few catalysts behind the weakness. This includes a stronger US dollar, given rising Fed rate hike expectations, soaring commodity prices, and the negative implications for Korea's external position, as well as the risk of a global slowdown. But a lot of this bad news is already priced in. So we do see scope for a turnaround in the won on the back of improved sentiment. I think it's quite notable that, despite the move up in US yields, the dollar index has largely remained in the range. So that suggests that, the aggressive Fed has already been more or less fully reflected in currency markets. Also, equity flows have been one of the major drivers behind the won weakness. But once investor sentiment recovers, we could start to see equity flows turn around, and this will be supportive for the currency. In fact, foreign ownership of Korean equities have been on a decline in recent years, so positioning is already quite light. Another factor to consider is that market positioning is probably long for the dollar-won pair, because the won is often used as a proxy to express bearish sentiment in the region. So we could see a positioning unwind there as well. Because as Khoon mentioned earlier, there are tailwinds to the region's economic outlook from the pandemic-related reopening and also the associated release of pent-up demand. So overall, we see the won ending the year at 1170, provided we don't see another major escalation of geopolitical tensions in Europe. So let me stop here and hand back to Rowan.
Thank you very much, Krystal and Khoon, for your presentations today. ANZ is a strong supporter of the Australia-Korea business community, and we're very honoured to have you as our gold sponsor. Also, I'd like to thank all those who tuned in, both in Australia, Korea, and within the region. If you have any questions, be sure to contact either myself or my team, and we'll be sure to follow up with those at ANZ. Until we see you next time, thank you very much and keep safe. Thank you.